Well, the spike in oil and natural gas prices from the Iran conflict may seem eerily similar to the 2022 energy crisis.
But the economic backdrop now looks very different. In this next report from jobs market to monetary policy, we dive into what has changed over the past 4 years. Take a look. A glance at the surge in energy prices and the market reaction to the Iran conflict seems similar to the start of the Ukraine war in 2022. But is 2022 really the right playbook for how this crisis plays out in the global economy? To state the obvious, that is going to heavily depend on how long the conflict lasts and how long the Strait of Hormuz is de facto closed. There are two scenarios to base the outlook on. The first one is that the disruption is relatively short-lived. This is a case where supply begins to normalize after 4 weeks, bringing energy prices down into the second quarter. The macro impact is relatively contained. In this scenario, Eurozone inflation heads briefly to 2.5% in the June quarter, and the US and UK to 3%. Enough to delay, but not derail, further Federal Reserve and Bank of England rate cuts, and not enough to move the ECB out of its good place. The other scenario of prolonged war would mean a much larger supply shock for global economy. Qatar warned that it will take some time for energy deliveries to return to normal, even if hostilities end immediately. So a prolonged conflict would mean a much worse outlook. Analysts at ING markets say 3 months of full disruption would take crude prices above $100 per barrel. Still, the starting point for the global economy looks very different right now from the beginning of the 2022 energy shock. Back then, the jobs market was still grappling with the fallout of the pandemic. Since then, the jobs market have dramatically cooled. Vacancy rates have collapsed across the world. In 2022, the strong jobs market helped protect consumers against the energy crisis. That is much less true today. 4 years ago, central banks were able to hike rates aggressively to bring inflation down. But with the growing outlook already tarnished from President Trump's aggressive trade tariffs, major central banks will find it difficult this time. Business Bureau Report, WION World is One.